Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to share with you a really low-risk, high-reward, defined risk type trade setup that I like to use for certain situations, especially like breakouts. So here's an example. This is Microsoft, and Microsoft had a pretty good pullback here, and it's setting up here right above that 50% retracement level where it came down and held that 618 back to the 50%. So if Microsoft can get through this 382 right here, it's got a potential to go back up towards that prior high. So one way to trade it is to use what we call a long call Condor. So it's a combination of a call debit spread with a vertical credit spread. But what it does, it gives you very, very low capital at risk and a potential for a high reward on that. So let's take a look. So the basic structure is to look at a call debit spread, and typically I'll look at something like a 50 delta or 45 delta. So the long strike, this is a 21 August series, 9 days expiration. So you don't want to do this too far out in time because you want to take advantage of the accelerated theta decay from your short option part of the spread. So this would be buying like that 46 delta long, the 210 call, and then selling the 212.5 against it. So call debit spread $2.50 wide. And then typically what I'll do is I'll go out and I'll look for the 20 delta to short strike to sell a bear call credit spread with the 20 delta short strike. So that'd be selling the 217.5, 220, keeping it balanced at $2.50. Now you can make it $5, $10 wide, $2.50. You know, it's a lot of different ways to do it. And then the other thing I like to do is if you buy the vertical debit spread and you get a big pop to the upside, then you can reduce your exposure. Let's say it goes to 215 tomorrow or the next day, and then at 215 when it's trading there, you look and sell the 20 delta on that. So that'd be probably something like the 222.5. So you can lay off some of that risk. So here's what the trade ends up looking like. So you would have this as your call debit spread. So the 21 August 210 long, short 212.5, $2.50 wide spread. Maximum risk debit paid $89. Potential maximum reward or profit would be if it closed above 212.5 at expiration on the 1st of August. You'd make $161, which is 180% return on your risk. Not too bad. But you've also got negative theta, so you're losing about 67 cents a day. So if we wanted to convert it to a Condor, we could sell this 20 delta short strike 217.5, 220, bringing in right now about $31 credit. Now we've reduced our risk down to $58. We've got positive theta, and at expiration next week, if it goes out between the short strikes here, you make $192 per spread, which is a 330% return. So a lot of different ways to do this. So options are just really amazing and a lot of fun because you can do so many different things, and that's why they're called options. And if you'd like to learn more about options and the different various option strategies, I'm going to be doing a free no-cost option trading webinar workshop this Saturday, August 15th. So sign up for it on this email, and hopefully I'll see you this Saturday. Good luck trading.